Hello everybody. Welcome to Explore the World of Finance from Capitant. Thank you for coming. If I may ask to put yourself on mute, you can ask a question after this meeting in breakout rooms with a specific speaker if you want. And maybe to get some interaction, it is likely to put on your camera. It's not necessary, but it will be lovely. So welcome everyone. The financial sector has a varied range of subsectors. In the world of finance, we have like private equity, we have consulting, we have investment banking, and so on. But what does this exactly mean? Today we have from Capitant Gent, we have 6 speakers for you who will discuss those topics and give their insights and expertises on those subjects. So I would like to start with Thomas Batsleer. In the past, he was like director of Capitant, which is very cool. But today he is an associate corporate finance at TMT, ABN AMRO Bank. He will tell us more about investment banking. So I would love to give the floor or maybe the screen to you, Thomas.
Yeah, unfortunately not the floor. That was the initial plan, but unfortunately there's this little pandemic that is ruining the show. Let me just see whether I can share my screen with you guys. That's gonna make it all a bit more convenient. Just to check, Andreas, can you see it now on full screen, my presentation?
Yes, I do. Thank you.
Yeah, perfect. Okay. Oh, a bit too far already. I'm Thomas, calling you from Amsterdam at the moment where I work. A little bit of background on me, maybe before we start into why I went for investment banking and what I did to get there. So actually, I studied business engineering in Ghent, did a bachelor's and a master's there, and during my third year of my bachelor's, started searching for something a little bit more challenging. And that's when I joined the founding team of Ghent, of Capitant, together with a few other people. We launched Capitant in Ghent there for the first entire year, and it was a huge success, and it still is. So it's great to do these kind of events now for you. So after my period in Belgium as when I finished business engineering, I did an additional master's in corporate finance at ESCP Europe, because basically at Capitan I already started discovering a lot of different fields of finance. And maybe interesting for you is that when I started business engineering, I told my parents that I never wanted to work for a bank. Well, that went horribly wrong. So I did my master's in corporate finance at ESP Europe. Very interesting. I was half a year in Paris, half a year in London. And you basically have everybody from all the bulge brackets who are teaching you courses. It's very insightful. Of course, then I looked in Paris and in London for internships. But I came across an interesting opportunity in Amsterdam. So I thought, okay, yeah, whatever, let's give it a try. Let's do this for 4 months. And then we can still go to London. Well, 4 years later, I'm still in Amsterdam. So it looks like it wasn't that bad. I did my internship at ABN AMRO in the corporate finance team. After that, I joined a venture capital fund in Amsterdam, INCAF Capital, which is €500 million fund for technology and life science investments. I mainly worked on the technology deals. And then after that, I rejoined ABN AMRO. That's now 2.5 years ago. I'm now a senior associate within their team. So what I'm going to do today is I'm going to explain you a bit how an investment bank looks like and what the different types of jobs are that you can do there. I'm going to focus on a little bit more on the corporate finance side of it. So how does a typical M&A process look like? Because that's typically always something you get in interviews that you get for investment banking internships. And then after that, I'm going to give you some tips and tricks on how you can get in and how you can ideally prepare yourself for such an internship. So first thing, if you look at an investment bank, typically people think, oh, I'm going to do M&A. It's actually a lot larger, quite a lot larger. So you have all kinds of front, mid, and back office jobs. I'm not going to focus on the mid and the back office jobs now. I'm mainly going to focus on what we call front office jobs. So typically what you see there is a corporate finance department, a sales and trading department, and research people. That's in general, in a nutshell, a bit what you see. If you look at the sales and trading department, that's typically everything that is markets related. So typically, if you need to make the choice between corporate finance and sales and trading, I always say, are you a morning person or are you an evening person? So if you like to get up early, then sales and trading is definitely something for you because they typically start at around 6 or 7 in the morning. At corporate finance, it's fine if you start between 9 and 10, but you go on until after midnight from time to time. Sales and trading, there everything is related to financial markets, so public financial markets. So what you typically see there is you have equity sales desks, so that's basically the equity traders, like you see in a lot of movies. You have fixed income sales, for instance, that's more the debt products. You have syndication teams, you have people who are involved with derivatives, you have people who are involved with corporate broking. So think about, for instance, organizing online shareholder meetings and administering stock option plans for companies. That's what you see in there. Then if you look at the corporate finance side, what you typically see there is that it's structured in 3 buckets. So one of them is the product teams, one of them is the sector teams, and the other one is country coverage teams. I think country coverage teams, that's an easy one. That's basically people who are either on the ground or based in London and will cover a certain geographical region. Then sector teams, I think that's also quite an obvious one. For instance, I work in TMT, tech, media, and telecom. And I then within that sector focus mainly on software companies. But yeah, you have all kinds of other teams. There are a few examples there of what you typically see in banks, but that differs for every bank. But that's always something that you will see. And then you have product teams. That's basically different types of products. So M&A is one of them. So what you typically see there is you help with advising companies on selling themselves. You can help them with raising capital in private markets. You can help them with buying other companies. You can do advisory around optimizations of their balance sheet. So there are a lot of options there. Then equity capital markets, that's a bit in between the sales and trading and the corporate finance teams typically. So what these guys do is they basically, some of their products are IPOs, so bringing companies to the stock exchange, or accelerated book buildings when you want to increase the capital of companies, or rights issues. So those are all types of products they have there. Then you have debt capital markets, leverage finance, and project finance. So what you typically see, for instance, with leverage finance is private equity related transactions, so the funding of it with debt. That's what you quite often see there. And project finance, there you have to think about large infrastructure projects. So imagine that you want to build a new oil pipeline to somewhere in the Middle East. Funding that is typically something that people at project finance do. Or if you want to build an airport or a new highway. So that's typically a bit how it is structured. And typically, when you work on a certain deal, it's always from each bucket that you will have someone. So for instance, last year, I did the listing of a Dutch software company. So then, for instance, I worked together with people from the equity capital markets team because they have more knowledge on doing IPOs. I was there more to make sure that their equity story of the company was right. And then we had people who are focused on coverage of Dutch companies. So that's a bit typically how the setup is. So if you look at how a typical M&A process works, there's a lot of text here. It looks very unsexy, but I'm going to walk you a bit through it to make it sound a little bit sexier. So typically, it all starts with sourcing a deal, because you can't do a deal when you don't have it. And then, yeah, it all depends on what kind of deal you want. So typically, what happens is that you're always going to try to get a sell side mandate because that's more certain than a buy side mandate. So that's something that a lot of banks will also pitch for. But of course, only one or sometimes two or three can have the mandate to sell a certain company. So typically, the ones who don't get the mandate then try to get a buy side mandate. So they try to find another company or a private equity investor that eventually wants to buy it, and then they team up with that party. But what is typically all included in such a pitch? That's, for instance, one of the interview questions that you will get a lot when you interview for investment banking internships. So always something you include. It's very basic, but a lot of people forget it. But you always describe what your deal team is and what the experience of those people is. You explain a bit more on the capabilities of your bank, and you show that you can help them with multiple products if that's necessary. You show them your credentials. That's a very, very crucial one. That's often a deal breaker or a deal maker, your credentials. You give your views on the market and all the dynamics and trends. Basically, the company always knows it better, or most of the time knows it better than you. But that's also to show that you actually know what's going on, so that they actually also trust that you are somebody credible. You also give your view on the business, and that's typically in the form of an equity story. So what you do there is then that you basically, it's basically marketing. So how will you sell the company, and what are the key investor elements that are in there in the business? And then you explain them a bit on how such a typical process looks like. That's typically what you're going to do when you are talking to people who don't have a lot of experience with these kinds of M&A processes. You give them an overview of who potential buyers might be, and you give them some insights on what the valuation could be. So imagine they were very convinced about all your materials, and you win it. And I can assure you it's a little bit more difficult than how I described it now. You easily need 5 to 10 meetings before somebody starts trusting you, and somebody starts thinking about maybe giving you a mandate for such type of process. But imagine that you won it. Then typically you have one big kickoff meeting where you will also have all kinds of other advisors. Like think about one of the big four, which typically is the financial advisor. You will have lawyers there as legal advisor. Sometimes you also see people from strategic consultants there when there needs to be commercial due diligence reports made. You can also see people, for instance, from technology advisors when technical components need to be assessed. So all these people will be there, and that's typically the only moment during the deal that you see everybody in real life. So then you start with all the preparations. Think about all your marketing materials that you're going to start prepping. So that's typically a teaser, an info memorandum, and a management presentation. That are the key marketing materials you have. And then on the side, you also start prepping your data room for further due diligence, and you make sure that everything is quite streamlined. So then typically you start having fireside chats where you send out your teaser to various parties and maybe already have interaction with them to see a bit what their first questions are and whether they are actually interested or not in buying this company. And then after a while, you will say, okay, now we go to the market, and you send your information memorandum to all these interested buyers, or not to all, depends a bit on how you structure your process. Then after a period of a few weeks, typically 4 to 5 weeks, they will come with a non-binding offer, and there you will select, let's say 3 to 5, sometimes a bit more, parties with who you want to continue. And they will get access to your data room, they will get access to management for management presentations, they will get access to due diligence reports that the other advisors made. They can also sometimes have expert sessions with these advisors. And that's basically all to make sure that the burden on the management is as low as possible. And then after that, after typically 5 to 6 weeks, they complete their due diligence. Then you're going to decide who the best one was, and that's not always priced. There's also a lot of other elements that you probably heard at school. But then you do your final negotiations, typically on your share purchase agreement, sometimes also on your shareholders agreement when you don't sell 100% of the business, and sometimes also on the transitional service agreements. And then you have, of course, the closing party, not to forget, very important one. So just to give you some background on something I worked on, how that typically works. So this is one that you all know. You're probably all very big fans of pizza.be. This is basically the parent company of it. And we did a lot of transactions for them. So I think we did more than 10 different advisory mandates for takeaway.com. And one of the things we helped them with was acquiring the German assets of Delivery Hero in Germany. Because the thing is, all these marketplaces typically work best when there's a quasi-monopoly. And the problem was Takeaway had somewhere around 40% of the market share in Germany, and Delivery Hero had around 40% of the market share in Germany. And they were basically just fighting heavily with each other with marketing budgets. For a few years, everybody was looking whether Takeaway would buy Delivery Hero or the other way around in Germany. So eventually it became takeaway.com, and then you basically helped them with everything around negotiations, but also with assessing how much they could potentially pay for it, but also thinking about how you could finance those deals. So literally everything around it. And I can assure you that's quite fascinating to do. So then some tips and tricks on how you can get in. Online applications is something you will always have to do for banks, but the possibility of getting an interview after an online application is close to zero, I would say, especially for bulge brackets. If you want to increase your chance of getting an interview, make sure you send people on LinkedIn, search fellow Belgians there who work there at those firms, ask them for advice and ask them if they maybe can speak to HR to give you a push your application. It's really important, otherwise it doesn't work. The second one, that's a bit harder now because you don't have a lot of recruitment events, but make sure to attend a lot of those, and networking is really important, but try to be a bit genuine. You easily see it when somebody just tries to impress you, but they only do it because they want to impress you and they're not genuinely interested in the business. And also try to make sure that you know a bit whether you are more interested in a bank or a boutique, and definitely check the culture of the various teams, because I can assure you, even within banks, there are huge differences between different teams. So definitely assess that as well by trying to speak to people who work there so that you know a bit what the culture is. So who are typically a bit the people that get in? It's people with a lot of perseverance, because it's not easy to get in. Typically, as a Belgian, because Belgians are always underprepared. That's something I see a lot if I compare it to Dutch or German or British interns. Belgians are always less prepared, but during their internship, they always perform better. or in general. So the thing I would like to say is definitely prepare yourself as good as possible. So things like the 400 investment banking questions and the Vault Guide to Investment Banking are really, really important because almost all questions from technical interviews come out of those two reports. Also, try to look up some deals that bank did in the past because that's also just going to increase your credibility. But they all search for people who are nice and who want to go the extra mile. Because the thing is, there's no 9-to-5 mentality. You're going to have to work very hard here. But if you work very hard and if you work long hours, then you want somebody next to you, or now on the other side of the line, who is at least nice to have a chat with and with who you can sometimes joke a bit around or go for a beer. And that's also something they actually really, really, really search for. So yeah, that was it. The thing is, investment banking is quite a word that always sounds very trendy and sometimes a bit scary. It sounds very fancy, but I can assure you, it's super interesting, but it's hard work. But I can assure you, it's definitely worth the investment in your career. So with that, I'm going to hand over to the next one, and happy in the breakout room later this evening to answer all the questions you might have.
Okay, thank you, Thomas, for your insights, and I hope it was clear for everyone. If you still have questions, like Thomas said, there will be a breakout room after this meeting where you can ask all the questions you want to ask. Next, another time, thank you, Thomas. Next, we have venture capital. Venture capital is a sub-sector in the finance world where the word risk is like central. For this subject, we have Lucas Stoops. Lucas Stoops is also ex-Capitant director, and currently he's manager at Force over Mass Capital. So yeah, Lucas, the floor is yours. Thank you.
Thanks, Andreas. Can you see my screen?
I do, yes.
Okay, perfect.
Thank you.
Good evening, everyone. So indeed, my name is Lucas. I was actually one of the 3 co-founders of Capitant. I was the president the first 2.5 years, and I'm still, part of the alumni organization as well. Maybe quickly about myself. So I studied economics, TEW at the University of Antwerp, and afterwards did an internship at Ageas. It's an insurance company above AG Insurance. And after that, I went into investment banking like Thomas did. I went to London. I was with JP Morgan for 3 years. And after that, I basically joined Force Mass Capital, which I will tell you about in a bit, but of course also about the industry. I've been now at Force Mass Capital for 5 years. So it's been a while, a bit older than you guys. And in the meantime, I also did an MBA at INSEAD. So I went back to study. I was in Singapore and Fontainebleau for a couple of months. But that being said, what I would like to do is maybe introduce you first to venture capital. And to set the scene, it's important that you guys understand, I think, how the market typically worked. And so if you look at, the 1990s, what happened there is basically the computer got invented. The microchip was invented. Microsoft was able to create a processing system, an operating system, and all these, more old school names in technology world started to emerge. The 2000s, really interesting. The consumer got connected, and I think these brands like Facebook, Amazon, Google are a bit more familiar to many of us. But this was really when basically the internet really kicked off, and you saw really the technology industry as such emerge. Now, what's really the cool part is basically where we are today is phase 3, is where technology, basically every industry is now technology driven. Don't forget, it always used to be like that, technology driven. Everything you make, if you make a cup or if you make a car, it doesn't matter. There's always some form of technology or in the machine or anything. But what you see now is that all the benefits of technology and software in particular are enabling new sub-industries. And that's what we call the fintech, the clean tech, the green tech. Basically, every industry now gets disrupted, a fancy word in the VC world, gets disrupted by venture capital. And that basically allows for quite, interesting companies. It touches our daily life already. I think, easy examples are, Payconic, I think in Belgium is an easy one that speaks volumes. And retail tech, you have bol.com, all these companies. So many more things are happening, and that's quite interesting because you really see the fourth industrial evolution happening, and that's basically driven mostly by much more awareness in technology and much more openness and much more people entering the labor force there, but also really because of the advancements in cloud computing and artificial intelligence that have been recent but very, very, very significant. So quickly on our firm, I'm not going to pitch you our firm, but just so you know where I come from. So for Capital, we are an early stage investor. So we across Europe invest in seed companies. The way you should think about seed and Series A companies is companies that are 2 to 5 years old, have 1 to 2, 3 million revenue, but that are really looking for capital to really scale their operations. We are quite active in the big data and AI space, also in the fintech space, and industry 4.0 as well. We have 2 funds from which we invest. In the UK only, we invest very small tickets, just really to get first 500k to get a company going. And then next to it, we have a big fund that invests both the UK but also the rest of Europe. That's a fund where we typically initially deploy 1 to 5 million pounds. And we've actually also made the first Belgian investment, so I will get to that a bit later. What's also nice to know is maybe we are 7 people in the firm and 4 of them are Belgian. The big boss is Dutch guys, so we're actually quite, we are based in London, and most of us, but we have quite a Belgian angle. So what is important in VC? First of all, deal sourcing. I think Thomas alluded to it as well. Compared to what some people think, deals do not always come to you. You actually, where you make a key difference against your competitors is by deal sourcing. And the way we do that is we see around 1,200 companies a year that we come in our inbox that we see a presentation from. And basically from those, we select around 1/3 that we think, okay, that's actually quite interesting. We should maybe do a bit more work. Typically, we invite them for a Zoom call. Nowadays, it used to be meetings, of course. We do Zoom calls or we do first meeting to try to understand a bit the basics. What do they do? How is the management team? Are they the right team to do this? How does the business model work? Very important, all that stuff. If you like what we see, we start to do a bit more research. We invite them for a second meeting, for a third meeting. And basically, if the initial due diligence is done correctly, then we go into advanced due diligence. And that's where basically we really do a deep dive on customer clients, are all the legal documentation, is everything okay, and so forth. And after that, we make an investment. First of all, if you issue a term sheet, if you don't know what a term sheet is, to put it very simple, it's, let's say, a 2-3 page document with the key commercial terms where we say, look, these are the commercial terms, how much you want to pay, do you want to sit at the board, all that stuff. And if people agree on that, then we go into the full documentation. Obviously, it doesn't stop there. We also do things after we invest. Typically, we take a board seat, so we go into the board of directors of a company, and we have a couple of key areas that we focus on. First of all, how is a board structured? I think that's always very important because a board can be very inefficient. Don't forget, these are not public companies. It's not like KBC where you have a 10-people board of very senior executives. These are typically boards of, in the beginning, early stage investors or advisors. And so we want to make it more professional and basically create put the right people in the board, because it's really important to set the strategy of the company. We look at the team structure. Is everyone incentivized in the right way? Do people have enough equity? Do they get paid enough? Is everyone doing what he needs to do? Maybe it's time to say goodbye to some people who were there in the beginning, but they're not, that don't fit well in the story that we are today. Maybe we should hire extra people. That's the things that we're looking at. Your business model, strategy, and process obviously speaks a bit for itself. Super key strategically, and we're trying to see, okay, is this the right price to ask our customers? Are these the right customers to go after? Don't forget, these are young companies. They're companies with 1 to 2 million, 3 million in revenue. And typically it comes from 5 to 10 clients. So it's young. So that means, are we doing the right thing? To ask that question is really important, because if you make a good strategic decision, it can really create a lot of value for the company. If you go completely the wrong way, you might lose a year, and that's really not beneficial, of course. Financial planning KPIs, keeping the company in check, making sure that they report the right things to investors and that they focus on the right things. That's quite important. And then obviously companies we invest in tend to lose money. People in some industries find that a bit strange to make this type of investments. But don't forget, when we invest, it's typically to scale the business. And by that I mean is, on an operational level, the business is doing okay, meaning they have 5 or 6 clients. If they would only serve these 5, 6 clients, they would be profitable. But what they want to do is to say, look, our technology actually works quite well, but we can have 100 clients. So why do we need to wait until we, make enough money to hire, one person, another person 6 months later? Why don't we just raise capital, sell a bit of shares, so we can immediately start hiring, for example, 10 people extra and really scale that business. So that's typically where we as a fund focus very much on. The business on an operating level, meaning what they do today, that needs to work, but really want to put in money to scale the operations so they can really significantly increase their revenue. I know this sounds might a bit abstract to some of you, so I thought, why don't I give 2 examples that you have a bit an idea how venture capital looks like. The first company is actually a Belgian company. So January this year, we made the first investment in Belgium, and the company is called Tangent Works. It's tangent.works if you want to look it up on the internet. And so basically what they do is they provide you machine learning as a service time series. Now, I understand that it's a bit abstract, so let me give you a concrete example. For example, if there's an energy company, let's say Elia, and they have a big spreadsheet of data where they say, look, at 1 p.m. so many people used this amount of energy. At 1 minute after 1 p.m., so many people use that amount of energy. Yeah, obviously, it's a bit more complicated than that, but if you make a big spreadsheet with a lot of time series, you have a time during the day and you have an output. What Tangent Works basically does is they say, okay, look, why don't I look at all the data? I create myself an AI model that can predict the future of this data set. So for example, if you have a big data set of energy consumption of, let's say, 5 days, what does Tangent Works do? They say, okay, I create an AI model automatically for you, and now you can predict what will happen on day 6 and 7 based on the data that you have over the first 5 days. What's cool about this? Normally, when people who work in artificial intelligence, they will start creating the model, and they need to see, okay, does this work? How is this predicting? Well, actually, Tangent Works says, look, I have many automated models. I give you one example that you can run, and it immediately predicts very well the future. And then you can start making adjustments to the model, and actually becomes a lot easier for people who work in artificial intelligence to start forecasting the future. Don't forget, it's all related to time series, where you have a lot of very clean data. That's really important. They're doing really well. They're selling in the US, they're selling in Europe. They're actually, they're situated a bit above Brussels, and a lot of the technical team is in Slovakia. And so it's quite exciting what they're doing. It's a young company. We're quite optimistic. You will hear about it. In the coming years, you will definitely read about it, according to us. Second company, Admix. That's really a cool one. I'm not sure how many gamers there are in the room. I presume many of you play a bit more video games now we're in this lockdown. And there might be a good chance that the advertisement you will see in your games will be powered by Admix. Now, if you play, let's say, a mobile game today, I'm sure you've all been there, where you go from level 1 to level 2, and you need to see this very annoying 20-second clip, which you really want to click away, but you need to see it, because otherwise you cannot go to the next level. Basically, what Admix does is they say, look, that doesn't work. What you need to do is you basically need to create advertisement within the game. And so the way you should think about it is, let me give you an example of, Grand Theft Auto or FIFA or any of these games. I think Grand Theft Auto is an easy example. And you walk through a city where you do a lot of missions. And basically what Admix will allow you is, if you walk through that city, you will see billboards, like in real life. If you walk the Mare and you see a billboard of H&M, what Admix will do is, if you walk through a virtual city, the game developers can place billboards, and AdMix will automatically place the right advertisement on the billboard. Just like if you go to Google and you go to certain websites, you get advertisement there based on your cookies and all that stuff. Basically, AdMix will do the same, but in a game. And so you will see real advertisements specifically for you, which is really relevant. To give you an idea, League of Legends may be played by some of you. They did a deal with MasterCard where every game of not every game, but many games of League of Legends, you will see a MasterCard flag in the game. And what AdMix basically would do is, instead of a MasterCard flag everywhere, it will be a dynamic billboard where, you know, for example, I could see advertisement of football, Thomas would see advertisement of cheese, and so forth. So it's all dependent on what you do. And basically, this allows the game developers to create a lot more revenue, because not only will people buy the game in the App Store or whatever, but they will actually make a lot of revenue from the advertisement that they will sell within the game. It's non-intrusive. You won't really see it as a gamer. It's more that you create brand awareness. Like if you walk in the street, you see H&M, it's not that you immediately say, oh, I need to go there. It's you put the logo in the back of your mind, and that's what they want to do. And so it might be happen that in the coming weeks or months, if you play some of the games, actually the advertisement within the game will be powered by AdMix. And to give you an example, one of their developers, they put on the AdMix platform within their game, and they were able to generate 30% more revenue day over day. So basically day one, just let's say they had 100,000 euro revenue, it became 130,000 the next day because they plugged in AdMix. So quite remarkable. We're quite excited about it. I'm really excited, and so let's see how that all plays out. So I also want to say something. If you want to work in venture capital, it's a bit, maybe I'm biased, of course, but it's a bit a sexy industry to work in because you work with technology, it's early stage, it's investing. So it seems that a lot more people want to break into venture capital, if you want to call it like that. First of all, compared to banking, it's completely different the way you need to approach it. In banking, as Thomas said, by the way, I did the recruiting with JP Morgan for the Belgians back in the day when I was there. So it's really very structured process. You need to apply, interviews. In VC, none of that is true for most firms. There are always a couple of exceptions. Some work with headhunters, but I think in 90% of the cases, it's really, do you know the people? If you see an advertisement from them that they're looking for internships or analysts. And so it's really, you need to be a bit plugged into the industry, or at least you need to really network your way in. I think that's very important to remember. It's hard to start in VC. It's funny maybe that I say it because at FunCap, we are one of the few firms that hires directly from the university. But we like that approach. We tend to hire very talented people. Actually, one of the people that we have is Thibaut. He actually studied like you in Gent, and I met him through another Capitanter who was in Capitant Gent. And so he came via Capitant with us. But it's already 3 years ago. And so it's best maybe to get a bit more experience somewhere else. I think banking is a very good place to start. I think consultancy is a good place to start because you get very process driven, meaning you get very good eye for detail. You know how to build a PowerPoint presentation or to model in Excel. You're a bit more mature in the sense that you have a bit more business acumen than if you would go straight out of college. So I think typically, 2 to 4 years, I think that's a great learning school, I would say, to enter into venture capital. But every firm is different. Again, we are one of the few firms that tend to hire from the university straight, but most firms require a bit of experience. Sometimes I hear people say, I'm going to work for a startup and then break into VC. It sounds good. I know it sounds really good, but in practice, it doesn't work most of the time. It happens when you become the head of sales of a very successful scale-up that gets sold for 100 million. Yeah, then you have a good profile, but typically just working in a startup or scale and doing 3 years experience, very, very, very few people manage to get into VC. So make sure you have a bit more general background. I think banking consulting is the right way to do it. Firms tend to also be a lot smaller, so they require you to have certain skills already. But you can all learn this. There's nothing to worry about. It's not rocket science in many cases. So, but lifestyle, Thomas, indeed, when I was in banking as well, it's tough, but it's definitely doable. Don't be scared of it. I think in private equity or VC, it's a bit different. First of all, every firm is different, meaning you can work really, really hard in VC, or you can have a more normal lifestyle, if I may call it like that. I think we are a bit in the middle. We all have a normal life and really try to avoid weekends at all costs. So, I'm in a really happy space. It's working hard, but it's really manageable. I have dinner every day at 7 at my place. So it's quite okay. It's different than maybe if you would start in banking or consultancy. Recommended skills, you need to be very curious and eager to learn, because obviously what you do all day is look at companies and make a sense, get a sense of, do you want to invest money in it? So you need to be very curious, eager to learn, and obviously ideally you have have an appreciation of technology as well. First of all, when I rolled a bit into VC, because it was an old senior guy at JP Morgan who brought me into further math. But you need to like technology, otherwise there's no point. Don't forget, I was definitely not a tech freak. I like companies like Tesla and Apple and all that stuff, don't get me wrong. I was really more on the tech side. Also in JP, I was on the TMT team, so technology team at the end. But you need to have that sense of companies that can really make a big difference. I think that's really important. You don't want to do this to find a company and invest, to grow revenue 10% and 20%. You really want to double the revenue. So there is risk involved. As Andreas mentioned, it's really about risk taking, but in a sensible way. Sometimes in the newspapers, it gets a bit overblown, I think, when especially SoftBank makes another 5 billion investment in a walk the dog app. That's not typically what we do, not at all. So, but you need to have an appreciation for technology. As I mentioned before, operationally and analytically strong. So that's why I always recommend maybe do something different first. But you need to have an eye for detail, and people need to really blindly trust what you send them. High EQ and social skills and integrity. Why is that important? It's a people's business, much more than I think some of the other businesses you will hear about tonight. Meaning we, in many cases, need to convince startups to take our money. The best ones, they get quite a lot of money thrown at them. And actually, just before this call happened, we had a discussion with a company we want to invest in literally an hour ago. And so he wants to raise 2.5 million, but he has commitments of 5 million. So we need to find our way in. And so we brainstormed this afternoon, how we can convince him that we are the right party. Brainstormed for an hour. We did the call. We're going to have a next call tomorrow. And hopefully in a week's time, I'll have good news. But so it's really about understanding people. How can I bring value? Be nice. Okay. And that's, by the way, true for every job you will do. Just be nice to your colleagues. It's really important. People need to give you, if you want to get somewhere and make it the next level, people, your colleagues need to be really appreciative of you and make sure that, they give it to you. Like, it's not always as easy as, hey, I did a good job there and I get the promotion. No, you need to get everyone aligned and people need to like you. Integrity, very important. If you lie or whatever, it's really deadly in every industry, but especially in ours, I think. And you manage money from other people. Okay, it's really different than some other industries, but people trust you their money. And so you need to do what you told them you would do. They need to give a feeling with you, okay, I trust this person. Many of the commitments of investors we had in our fund, it's not because they look, oh, for the mass capital, it's the best fund out of the 1,000 in the world. No, they had a good connection with us. They liked our story. They trust us. And that's why they went with us. So please, these things are important. If you want to meet new friends, it's important. But trust me, in business, super important and many times overlooked. So please keep that in mind.
Okay, perfect. I'm sorry that I'm interrupting you, but the time schedule is like...
Sorry.
So I would love to thank you for your insights, for the information. I hope it was clear for everyone. I will repeat myself. There's like a breakout room afterwards. So if you have still questions, you can still ask Lucas about them. Like you said, venture capital is nowadays still very popular. It's also often in the newspapers. And if I may make some marketing for Capitant Gent. We still do another event, Volatile Ventures in the Future, where we will discuss more about venture capital. So yeah, next we have Bart Gillis. Bart Gillis is a senior account manager, mutual funds at NN Investment Partners, and he will tell us more about asset management. So yeah, Bart, the floor is yours. Thank you.
Thank you. Can you see my screen?
I do, yes, thank you.
Okay. Thank you. I was listening to the other presentation, and I must say it's quite interesting to hear snappy presentations on other industries. So let me try to do the same for the asset management industry. You'll see that my slides are pretty light, so I'll try to tell the story. Obviously, if you have questions during the breakout or on the last slide, I've also mentioned my credentials like email, LinkedIn profile, Twitter account, etc. So please reach out in case you have additional questions today, tonight, or in the next few days. So let me start by saying what asset management isn't. Often people ask me questions like, what is it like managing assets? It's not like we swim in money, in dollar bills. This is not a picture of our employee lounge. We keep it quite, let's say, polite and quite humble. What it is, if I should summarize it in one single sentence, basically we manage other people's financial assets. And it could be very diverse in the sense that I plotted on this slide let's say a breakdown of my company's clients, sorry, so and then investment partners. And what you typically see is three types of clients. Let me start with the gray part of the pie chart. It's proprietary assets. It's rather typical for our company, but lots of asset managers in the market have or are part of a bigger group. Can be banking group, can be insurance group, which is the case in our company. So NN Investment Partners is part of NN Group, and we have also an insurance company within the group. And so typically for these kind of asset managers like ourselves, you will see that the proprietary assets, so the assets that we manage for other entities within the group, are in general bigger than for some of our competitors. So what does this mean? Obviously, an insurance company sells insurance products. You as a customer, or we pay premiums to the insurance company. This money comes in and must be managed. Obviously, this money is not put on a single on a simple bank account. It's managed with asset liability models behind it. Often in an insurance context, very long maturities. So in general, it's managed quite defensively. Lots of government bonds. And rather limited amounts of assets that are managed in the equity markets or the real estate markets. Often also quite illiquid investments like infrastructure projects, etc. So that's for NNIP. That's really the biggest chunk of what we do. We manage the premiums that our insurance colleagues get out of the market. And then typically what asset managers also do is we manage institutional mandates. So these are mandates, often large mandates. I'm talking about several hundreds of millions to many billions of dollars, euros for one single mandate. Institutional mandates, which means that these are companies that trust us their assets. Could be in a second pillar context, like pension schemes, pension funds, but could also be cash-rich companies that need a solution to manage their cash. and then we will take care of it, take risk in the asset in the equity markets, or invest it in a rather, I would say, safe way, again in money market-like type investments, or fixed income on the safe side, like government bonds, etc. And then the last part of what a typical asset manager will do is manage retail assets. So you will all have interesting jobs, I'm sure, in the next couple of years. Hopefully make quite a bit of money, and you will be able to either build a capital or even start investing as from the start when you start working. You can do it yourself, and I'm sure you're all very intelligent investors, as you are a member of Capitant, of course. By the way, I've noticed many of you are truly intelligent investors when I play investment games for Capitant. But often people who have a full-time job don't have neither the expertise nor the time or the willingness to spend time on investments, and so they outsource it either via their bank, via a personal financial planner, via insurance company. Doesn't matter. Often these assets come to an asset manager, and in a retail context, most of the time it's through mutual funds, typically investment funds that you all know via your banks. So the real basic mutual funds, and I'll give you a flavor of what exists in terms of mutual funds a few minutes from now, later on in the presentation. So all in all, as an asset manager, again, we manage the assets that are entrusted to us by our clients. Can be in-house clients, can be institutional large corporations, and can be retail money, retail assets that we manage most of the time through mutual funds. So just to give you an idea, and again, I'm not here to pitch at any investment partners, definitely not. My goal is to give you a short introduction to the world of asset management. And here I gave you a snapshot of the biggest asset managers in the world. I'm sure you've all heard of BlackRock, a lot of other well familiar names. In the previous presentation, I heard JP Morgan coming by. Well, JP Morgan, in terms of asset management, is the number 6 globally, so a really big player. Now, you all wonder where NN Investment Partners is on this slide. Well, it's next to this table, because we are number 75 in the world in terms of assets that we manage, which is nice, but doesn't make us one of the biggest names globally. However, in Belgium, if you look at the local Belgian context, then we are the number 3, more or less. So you have KBC, you have BNP, obviously linked to their big banks. And so then as number 3, 4, it's NN Investment Partners. So in a local context, we are quite important in Belgium. One of the reasons why we are not one of the really big, let's say, top 20 players in the world is because we decided to focus on a number of core strategies. So the big names that you see on the screen here, they do everything in terms of asset management. They'll have any type of investment funds. They do active, they do passive, all kinds of client segments. They often also offer risk-related products. They do everything. Within NN Investment Partners, we decided to focus on a limited number of strategies. Sustainable investing is very important to us, and I'll talk a bit later in the presentation if I have a few minutes left at the end. We also do multi-asset investing. So basically what we do then is build the portfolio for a client rather than the client using our funds or other funds as building blocks. In multi-asset, it's us who decides on the building blocks in the portfolio and the weights of each of these building blocks. And also very important, given the fact that we are part of a large insurance group. I think the number 4 or 5 in Europe and an insurance. As I mentioned before, safe assets like government bonds, can also be inflation-linked bonds, can be emerging market debt, so fixed income from emerging markets, can be anything, but clearly on the fixed income side we are also quite specialized. Now, if you look at the value chain of asset management, and again, it's really light what I will show on the screen. It's not it's not in each and every detail, but what you see here on the screen is what we call the investment engine of our company, and that's really the place where you have all the real managers, the real investment managers, so the people who take decisions in our investment funds or in our mandates that we manage. We are organized in different teams. We have a specialized fixed income team. We have alternative credits. We have fixed income solutions. We have AI, which is augmented intelligence investing. We have multi-asset, as I mentioned before, and we have specialized equity. So to show it in one single screen, the people here in the investment engine, that's typically what you probably have in mind when you think about asset management. These are the people who take decisions in our investment funds, what stocks to invest in, what sectors, what regions, etc. So these are really, I would say it's the core department of any asset management company. And of course, it is the case within any investment partners. But it's not all we have to offer for you trainees or later in your professional lives. Obviously, it's a whole value chain within our company with lots of other departments that are involved, that are working in the background, but that are at least as crucial to have to make sure that the assets that we have, that they are well managed. And personally, I work in sales and marketing, but you also have product management and development, you have legal and compliance, you have finance, you have we have at NNIP, we have a dedicated innovation platform. So there you have, for instance, a lot of data scientists. It's a job title that didn't exist when I started 12 years ago, but we've seen a massive evolution in big data and the way we try to use big data in the management of our mandates and our funds. So this innovation platform is really crucial and will be even more important in the next few years. Obviously, we have human resources, we have risk management, we have tech and ops, all very important departments. But again, the biggest chunk or the most important part of any asset management company obviously is this investment engine, where you have the analysts, where you have what we call the PMs, so the portfolio managers. Yeah, that's really where I would say the value of our industry is created. Quickly looking at the time. So just to give you a snapshot of all the different flavors that we, as I would say a mid-sized asset manager, have to offer to our clients. It's really, really diverse, and I will not go through this list entirely, but it gives you an idea that in terms of capabilities, investment capabilities and solutions that we can offer to our clients, it's really, really diverse. You have multi-asset solutions, you have fixed income solutions and equity solutions. And then below you have, I would say tens of different strategies that we can manage and that we can offer to our clients. Either we manage their entire portfolio, or they use building blocks within our menu, if I may put it that way. At the bottom of the slide, it's also interesting to mention that within the asset management industry, over the last couple of years, we've seen many more partnerships between asset managers to have a complementary offer. You see, the BlackRocks of this world, they do all themselves, but smaller and mid-sized asset managers, typically, they will partner up with other asset managers, and that's also something that we do. For instance, for senior loans, it's a very niche part of the fixed income solutions, US equity, Japan equities, US credits. These are typically examples of strategies that we use in our own funds, but that we, so to speak, outsource to other asset managers with whom we partner. For us, typically US and Japanese asset managers, because we have a focus on Europe. There's a home bias within NN Investment Partners. We are really focusing on European and Euro investments. So what do I do the entire day? Well, to summarize, and it's just a funny example, but in the evenings I try to host a few investment games for you, for Capitans, give presentations, etc. But during the day, as I work in sales and marketing, typically what I do is, first of all, make sure that our clients and our prospects are well aware of our key strengths as an asset manager. So in Belgium, multi-asset, sustainable investing, also on the fixed income side, many solutions that we can offer there. And so my first task is to make sure that the Belgian market is well aware of the key strengths of NN Investment Partners. What I also do, once we have a commercial relationship with a distributor, with a bank, with an insurance company, I will try to make this relationship as deep as possible by giving trainings. Really try to make the brand of NN Investment Partners as well known as possible within this distributor and within this insurance company. So on my side, it's really a typical sales and marketing job. I'm not a portfolio manager, but in general, if you talk about skills and what is it that you need to have to be successful in the asset management industry, I could basically copy the last slide that Lucas showed, because it's more or less the same for asset management. You need to have some experience. It's clear, especially if you go working in the investment engine. Typically, there you will start as an analyst, and after a few years of analyst work, you will grow in the hierarchy, and you will become a junior portfolio manager. And then after a couple of years, if you're doing a good job, you can become a lead portfolio manager for one of the strategies that I've shown on one of the previous slides. So that's within the investment engine. That's the typical flow, I would say. Start as an analyst and then grow into the portfolio management activities. Again, I repeat that we really are looking for let's say, mathematical profiles, the data scientists, the really technical guys. It's also very important for us because we need to, big data is there to stay, and we need to implement it in our investment strategies to be successful. Because in the end, what is the purpose of the asset management industry? It's to offer performances that are higher than what clients can get on a savings account. Because if we can only offer the same as the same yield as what they can get on a savings account, well, clearly they will not take any risks in the investment world. And therefore, for us, our main purpose is to make sure that we can offer above inflation performances to our clients, obviously depending on the risk they are willing to take. So I think I'll leave it there. Sorry for the 4 minutes that I passed 8 o'clock. But yeah, if you have any questions regarding my personal job or the asset management industry, I'll be around in the break.
Okay, thank you, Bart. Thank you. Next in line, we have Cedric Stichelbout. Cedric is portfolio analyst at Economopolis, a big company. Excuse me. And Cedric will tell us more about wealth management. So Cedric, the floor is yours. Thank you.
Okay, perfect. Thank you very much, Andreas. I'm very pleased to give you all an introduction to the world of wealth management. Let me first start by giving you a little background on myself. I studied applied economics at the University of Antwerp. After that, I wanted to learn more about asset management, so I decided to study an additional master at the Antwerp Management School, where I studied a Master of Finance. And then in 2018, I started working at Econopolis, which is a financial advisory and wealth management firm located in Antwerp. Currently, I'm working there as a portfolio analyst. Most of my job is centered around wealth management. So what I do is I make in-depth analyses for the wealth management team on individual and institutional client portfolios. But I also have some IT and middle office duties, but I will try to keep this very short as I only have 20 minutes. So quick word on Econopolis. Econopolis is a financial advisory and wealth management boutique. Currently, we manage over 2 billion euros in assets under management and supervision. Our organization was born during the financial crisis of 2008-2009. So that means that we had a blank page on which to design an entire new organization, taking into account everything that went wrong in the financial sector. Our investment philosophy is based on the books Econoshock and Gigantism. Both of them are written by our founder and CEO Geert Nulles. Econoshock describes basically 6 major econoshocks that will impact the economy and future society. So to give you a few, the rise of emerging markets, the transition towards a more sustainable economy, the transition from carbon-based fuels towards renewable energies, and the exponential growth of technology. The book Gigantism explains that companies and organizations are basically getting too big and too powerful. What we need is a more slower, smaller, and more humane economy. And that's what the book Gigantism is all about. Sustainability is key to our DNA. We firmly believe that sustainable investing is a powerful driver of long-term performance. So every investment we make first goes through a sustainability framework. It's something we do from day one. We're open to the world, but we're proudly Belgian. So our headquarters are located in Antwerp, but we also have a subsidiaries in Switzerland and in Singapore. We are driven by conviction. What do I mean by that is we are not afraid to stress the themes I just mentioned, our convictions, the Econoshock themes, into our investment portfolios of our clients. So we don't follow benchmark weights. Sectors like healthcare, technology, clean energy, etc., are typically overweighted into our client portfolios. We believe that these are the future-proof themes. These are the convictions that we want to include in our portfolios. Okay, let me try. Okay, so to align our investment philosophy and our convictions, we currently manage 9 funds of our own. Our fund management department is responsible for the management of these funds, and we at the wealth management department use those building blocks to construct a portfolio together with individual stocks and individual bonds, etc. We have pure equity funds. We have pure fixed income funds. We also have some multi-asset funds who invest in different asset classes, etc. So let's talk more about wealth management. Wealth management, in my opinion, is something of a broader term if you compare it to asset management. So we heard the talk of Bart Gillis. In my opinion, wealth management is something of a broader term, as I said. So services here are designed to aid a client or a company's financial situation overall, while also consolidating their long-term wealth. So this form of financial management takes into account all financial aspects relating to a client, which would include also taxation, insurance, retirement planning, etc. If we have a look at our activities at Econopolis, we can divide them into 5 main categories. 4 of them are directly linked to wealth management. So private wealth management, with our private wealth management team, we invest money of high net worth individuals in a responsible manner, in promising capital market investments, always within clear boundaries set with the client. And then in regular meetings, we will discuss together with the client the development of their portfolio, of their investments, and we will modify the strategic focus as necessary. So this is basically called discretionary portfolio management, which means that we are actually making the investment decisions and not the client. Institutional asset management is basically the same, but for institutions. Multi-family office for wealthy investors and families managing complex portfolios and often multi-layered portfolios can be quite challenging in terms of time and expertise. So at Econopolis, we offer services in this area as well. Wealth coaching. As a wealth coach, we offer independent and efficient assistance for families and institutional assets, but we're not actually managing the money. We offer knowledge about macroeconomics, asset allocation, security selection, etc. And then the last category falls out of the, let's say the wealth management department. It's economic and strategic advice. This is basically our consulting branch in which we offer strategic and economic advice to large federations, to governments, etc. So let's take a look at how we construct portfolios. First of all, we have 3 action items to get started before we start filling in the investment portfolio. We sit together with the client to define the short and the long-term goals of the client. So we wanted to know, to get to know our client. And then we need to understand their risk tolerance. So why is that important? The risk tolerance is the level of risk that a client is comfortable with taking to achieve their goals. Risk tolerance is basically the ability and willingness to take risk. The ability to take risk is more of an objective criteria. The willingness to take risk is more subjective, and we can try to know the willingness to take risk by using questionnaires to get a grasp on that. The ability to take risk is, as I said before, is more of an objective criteria. We look at the client's time horizon, the size of the portfolio of the client, and the client's spending needs. So the greater the size of the portfolio, the greater the client's time horizon, obviously the greater the ability to take risk. But on the other hand, if the client's spending needs are also high, then the ability to take risk will be lower. So all of that is translated into a risk profile. And then a third item, obviously, we try to minimize portfolio costs, as we realize that taxes and fees can also be a drag on portfolio returns. To maybe quickly further elaborate on the risk profile, I included a theoretical example of an investment grid that can be linked to a risk profile, in this case, a low risk profile. And this will be also included in the contract with the client. And it is a MiFID requirement to take the investment grid into account and to align the portfolio towards the investment grid that is stated in the contract. If we know all of that, we use a top-down approach to fill in the portfolio. We start with the asset allocation, and it's important to make a distinction between strategic asset allocation on the one hand and tactical asset allocation on the other hand. What do I mean by that? Strategic asset allocation is basically trying to strive towards the neutral weights that well, for example, in this theoretical risk profile, we want to strive towards 20% invested into stocks, 65% invested into bonds, 10% into cash, etc. Tactical asset allocation, what is that? In the short term, we can deviate from those neutral weights based on the current macroeconomic environment. If, for example, central banks are lowering their interest rates, we might want to step up the equity weight in the portfolio. And in this example, we can go up to 40%. So that is the tactical asset allocation. I also included the word rebalancing, I see, with strategic asset allocation. If, for example, stocks are rising in your portfolios and bonds are dropping, the weights will automatically shift from the neutral weight. So every year or every 6 months, we might want to rebalance those weights again back to the neutral weights. I'm stressing here asset allocation. Investments are divided into different asset classes, such as equities, bonds, property, cash. And these provide basic building blocks of an investment portfolio. So once you've decided on that, you might also want to look at a sub-asset allocation. To give you an example, if you look, for example, to equities, within the asset class equities, you can have a look at growth stocks, value stocks, European stocks, American stocks, etc. So it might be a good idea to think about that as well. And I'm using here the asset allocation because, as a matter of fact, several studies have shown that the most important decision when constructing a portfolio is actually the asset allocation decision. As a matter of fact, around 90% of a diversified portfolio's overall return is determined by the asset allocation decision. Only 10% is explained by the security selection and the market timing. I wanted to end this presentation with this graph to stress that, well, it's a common saying in finance that diversification is the only free lunch, which basically means that don't put all your eggs into one basket. What I did here is I plotted the world stock index over the last 30 years. And I also included the world bond index over the last 30 years and a mixed portfolio, which would have invested 50% into stocks and 50% into bonds. All of those indices are coded in euro. And what we see here is that the annualized return of a pure equity portfolio would have been 6.9% over those last 30 years. If you would have invested into the mixed portfolio, your annualized return would have been a bit lower, 0.3% lower, so 6.6%, but the amount of risk you would have been taken is reduced almost by half. And with risk, I mean the volatility in your investment portfolio. So the 50-50 portfolio isn't going up and down as much. So it has provided a much more smoother ride for investors if you compare it to a pure equity portfolio. That's because stocks and bonds typically, historically, they have a low correlation. So you might want to find asset classes with low correlations, and that's something that I wanted to end this presentation with. So yeah, that was it. I hope you learned some more about the wealth management industry. Thank you all for listening, and I will be more than happy to answer your questions in the private Q&A session afterwards.
Hey, thank you very much, Cedric, for your introduction and your insights and your speech. Next in line, we have consulting. Consulting is everywhere. It's really popular nowadays. I think we all heard about the Big Four. We have PwC, EY, and Deloitte. But today, Elise de Beukelare will tell us more about KPMG, where she works as a corporate tax consultant. So, Elise, the screen is yours. Thank you.
Okay, thank you very much, Andreas. Can you see my screen?
I do, yes.
Okay, perfect. So good evening, everyone. Tonight I'm speaking from Zurich. I heard some other presentations are also from other cities than Ghent and also outside of Belgium. So that's really the benefit this time of doing it online. So I'm happy to present you the topic of consulting tonight. First, I will introduce myself. So my name is Elise de Beukelare. I was born and raised in Belgium. I studied law in Leuven. And then for my master's, I decided to do a double degree master in Leuven and Zurich. And then after that, I decided to go back to Leuven to do an LLM tax, which is basically called in Dutch the Manama. And then I started my career in Zurich in the end at KPMG in international corporate tax. In my free time, I still like to learn languages, and I like to do sports like the triathlon disciplines and all mountain sports. So firstly, maybe what is consulting? It's a very, very broad term. It's a job title that could be used for, I think, mainly three subsectors. So first, you could have the strategy consulting, where you know the firms such as Bain and McKinsey and BCG. There it's very analytical and very broad, the problems you will get. It's mostly, you will have to make a process efficient, and it can be any kind of process. It can be industrial, but it can also be financial, for example. Then you would have the technical consulting, which is more boutique and more niche, such as, for example, Zanders. There you have that's a treasury firm. And then you have tax consulting and more audit and accounting. That's where I work in. And there you have the Big Four firms, and I'm personally working for KPMG. The skill set of a consultant, very important. So first you have the hard skills that really depends on the subsector you want to work in. For example, for my job, you need either a degree in economics, either a degree in law. And then as to soft skills, I think that's for all the subsectors. You need a very dynamic and flexible mindset. I mean, your day will not be clear in the morning always. So for example, today I was working on a deadline for next Friday, but then a client called with an urgent question, and then I had to solve that problem today. So that's why you really need to be flexible. You also need to have an international mind. You will be working with colleagues from all over the world, maybe in the office, or may it be on calls. You also need to be a good team player. And that's why I had this picture here in the PowerPoint. Just before I started at KPMG Zurich, they sent me a card to say, we're looking forward to meet you in the team. And I really like that social setting. And then also you need to be a networker. That's both towards your clients and with your colleagues. Towards your clients, it would be more to brand your firm. and to get a deal. And towards your colleagues, it would be more to promote yourself and to have a promotion if you're aiming for that. Which is what is also very important is communication, since you're working in a team, and also communication towards your clients. If you want to get a deal with them, it's very important that you are able to negotiate wisely. Then the next topic is why I personally chose consulting and why you also should, if you maybe match those criteria. First thing that I really like in consulting is it's an interdisciplinary business. In other firms, for example, in strategy consulting, you will have people with all different backgrounds, with all different kinds of masters. For my business, for example, at KPMG in tax, we work together with economists and legals. So I studied law, but I'm in a team together with economists, and it's really enriching to learn from them. What is also cool is how international it is. I mean, your clients as well as the consulting firms itself. As to clients, for example, in Switzerland, you may know many companies have their headquarters. A lot of banks, for example, we have as clients. And also we have a lot of big pharmaceutical companies with headquarters in Switzerland, such as Roche and Novartis. And it's really nice to see the whole world kind of coming together, and then looking at the daughter companies and such. You're kind of steering here at the headquarters. And then the consulting firms themselves, usually they will be active all around the world and have offices all around the world. Then what is also very important is it's a social job. If you don't like teamwork, definitely don't go into consulting. I really like teamwork, and I really enjoy it to learn from my colleagues, or if you have it's striking a good balance between being independent, so you solve your own problems, but at the end of the day, if you're not sure about something, you still have the team to fall back on and to ask your manager or a partner some questions if you would like. And then also the learning opportunities are very broad. For me, I see KPMG almost as a university 2.0, since they offer so many extra trainings, and I think you will have that in any consulting firm. For example, I'm also taking a Swiss tax expert exam, which costs about 27,000 euros. But then KPMG will pay the tuition fee for me, and they really support you to the fullest in your learning process. And that's really, I think, exceptional in consulting, how much learning opportunities you will still get. And then why did I choose KPMG specifically? That's also an important one. If you want to go into consulting, you will hear many times, oh, all the consulting firms, they do the same job. Honestly, to some extent it is true, because they're in the same business. If I would work at EY, PwC, or Deloitte, you do a similar job. However, it really depends on the mindset of the people in the firm itself. For example, I had job offers in different firms, and for me, a decisive factor with KPMG was that my mandates at KPMG would be much more broad. I would encounter more different questions than in other consulting firms, where they would focus on one topic, and I didn't want to specialize as from the beginning. And then a second thing that I would advise you to pay attention to if you ever apply, and that I also paid attention to, is you really have to be a fit within the team. Meaning that socially you have to feel well with those people, because difficult problems and hard clients, you will have them in any big consulting firm. And then it's really your colleagues that help you to go through those times, and that make the difference. And for me at KPMG, that was really during your application process, you have a lunch with other consultants. And after in the beginning, it was very serious and all about like what you told to the partners and the managers before noon. And then after 10 minutes, it was really casual, and we were talking about our hobbies and about someone who's skiing a lot and another colleague who's in a football team. And there I really felt a personal connection, and that was a decisive factor. Maybe it's cool to give you a day at the office, like an overview of what a typical day could look like. I would arrive at 8 in the morning. Basically, that's pretty early, but you're quite flexible as to your working hours. You just have to manage your workload during the day. So if you start early or late, you're really free to choose that, actually. I would start at 8, for example, and then take half an hour to read my emails, make a to-do list, and set my priorities for the day. Then I would take an hour and a half working for a client. And then we usually have a coffee break to catch up with our colleagues. Usually we have good coffee and bad jokes. I really enjoy that time, because then you get the time to connect with the people as well, and that's very important. And then I would take 2 more hours to have different calls with other KPMG member firms. For example, today I was in a call with KPMG Colombia and KPMG Amsterdam, because we had a global client active in those countries as well, and we had to find a solution for them together. So the calls with clients, you would directly call a client and inform them on what the solutions you offer may be, or it could be a call where you try to get the client, where you're not sure if he is a client yet. So that's a whole range of different calls you could have. And then I take 1 hour to have lunch with the team. And then after lunch, you would work for a client again. And then again, you have a coffee break. And then in the afternoon, what we often do is we have a couple of struggles on a client solution, and then you could speak to a manager or a partner. You're really free to do that any time of the day. It's just an example I gave here. And that is really cool, I think, in that learning experiences, they have so much more experience than you do, but it's very open to ask questions. I never had a question where they looked at me and told me, that's really a dumb question. It's really a very nice setting. And then at the end of the day, I would prepare my agenda for the next day and see what meetings I have. This is a standard day, but it really could go a lot of ways, as you might have heard in consulting. You really have to be flexible. However, I still manage to strike the work-life balance. If you find that important, it's really manageable to still have your free time. And then last but not least, how should you prepare for a career in consulting? Well, actually, maybe you're not aware, but you are at this moment. Capitant offers great opportunities, I think, for students to get in touch with professionals and to learn content-wise on industries. So first of all, it's hard skills. So give it your best at university and maybe pick up a summer school if you have the opportunity to do so. And then more general, I would say learn on the interests next to your studies. For example, I studied law, but I was really interested in negotiation. So I was part of a negotiation association as a student. And I think it really helped me, since now if we go to a client and have to get him as a client, it really helps to be able to negotiate wisely. Another thing is internships. In any consulting firm, you will be able to do summer internships or work half-time during the year. And then a third thing is be part of Capitant. It's a great extracurricular project, but there are also, of course, still many other associations that offer great opportunities for you as students to discover a bit of the professional world. I would say from my point of view, it will really offer you the ability to broaden up your network. So in any student association, you will see the alumni to whom you can connect, or you can go to recruiting events of firms. For example, as to alumni, I'm meeting up with other Capitant alumni here in Zurich as well. That's really fun. And then also the teamwork. You will learn to work in a team in different ways than you have your group project as universities. And especially if you're part of the board, you will really learn what teamwork is like. And then you will also upgrade your overall soft skills. I was part of the Capitant boards in Leuven, and there I had the function of corporate relations. So I had to go to partners and see what we could get as a deal, how we could work together. And that really helped me to like now lower the burden. I'm not so afraid to go to a partner negotiation, for example. So I would say really take the opportunity to learn at university already. Your extracurriculars are super important, actually. And then I would like to thank you for your attention. I hope you got a bit more insight in what consulting is like, what it could potentially be. It's very broad, as I told you. But I'm looking forward to your questions in the breakout rooms later. And yeah, thank you and see you later.
Okay, thank you, Elise, for the speech and for the little marketing for Capitant. It's really appreciated. So yeah, in my opinion, a job in the consultancy world is like real interesting. Last but not least, we have private equity. Private equity is ultra booming today, and Pieter Jan van Houten will teach us the know-how about it. So Pieter Jan, the mic is yours. Thank you.
Thank you, Andreas. Can you hear me? Just to double check.
I do. Yes, I do.
Okay,
hear you.
Perfect. And thanks for inviting me today. Really excited to speak to you all, and very happy to see that more than 80 people, I think, are tuning in on a Wednesday evening, 9 p.m. I guess Corona might have something to do with that. So you guys are all locked in at home, so you have to. The only thing you can do is watch me here. But I think the purpose of today would be I'm going to give you a brief introduction of the industry, explain you a little bit about how private equity worked, because when I was in your shoes, I actually had never heard about this industry, and I did not really understand what they were doing. So I'll try to demystify that a little bit. I'll then talk a little bit about my firm, EQT Partners, where I work for, what we do, kind of what we stand for. And I'll end the presentation with a couple of tips for those that are interested in joining private equity on how you can approach that and how you can kind of work towards that goal. So maybe first, quick background on me. My name is Pieter Jan van Houten. I grew up in West-Vlaanderen, Torhout, for basically most of my life. I studied in Ghent. I didn't study business engineering, but I was a mechanical engineer. I did a master in maritime engineering, shipbuilding more specifically. Very interesting, but never used that. And actually, immediately after university, joined McKinsey & Company to work as a strategy consultant. During my 2 years there, I really had a lot of fun. I focused a lot of strategic and organizational transformation topics. And then after that, went out to do an MBA at INSEAD. And after that, actually joined private equity. So I joined EQT Partners in 2017 as an associate in the Benelux team. I became a vice president earlier this year. And next to my geographical focus on like Benelux and specifically Belgium, I'm also part of our TMT team, which is basically telecom, media, and technology. And I am kind of the responsible for all our video gaming and broader gaming initiatives, an industry which I have a lot of passion for. So maybe first on the private equity business model. I mean, just in very simple terms, what we do is basically we try to go out and invest capital. And the way we do that is by acquiring businesses. Typically, in the case of EQT, we're trying to acquire full businesses, so majority ownership, so that we also have the control over the business. And then we keep them for typically 4 or 5 years, and then we try to sell them with a profit. So in principle, it's a very simple concept. You buy stuff. Ideally, you buy it cheap. You try to make it better. You improve it, and you try to sell it with a profit 4 or 5 years later down the road. In practice, it's of course a lot more complicated than that. So where do we get our money? We get our money from what they call investors known as limited partners. These limited partners, they're pension funds, sovereign wealth funds, wealthy individuals, large corporations that have large pools of capital and that need to invest that capital. And one of the asset classes they invested in, next to public equities and a whole bunch of other options, is private equity. So they then give us money and we invest that money for them on their behalf. And we do that by, as I said, acquiring companies. Now, how do we make money as a private equity firm? So we have actually two types of income. Our LPs, so the people that are supplying us with the cash, they will pay a fixed fee to us each year, which is 2% of the amount that they have invested. And when we realize a return, so when we make money, we actually get 20% of the value we have created, and 80% we send back to our investors. So we basically make money both on the management fee, which is kind of an ongoing fee to cover our costs, but the most of our money, we actually make it on the value we create. And that makes sure that kind of the incentive between the people supplying us with money, our LPs, and between the PE firm, us, is actually aligned. We both want to strive for achieving the best outcome and the best results. If we have very good results, then both the LPs are happy and we are very happy because we also made some good money. And this is kind of a continuous cycle. So it's called the fundraising cycle. So once, if you start out, you will raise a first fund, for example, you'll raise 1 billion, you'll invest that over the course of 2-3 years. Once you kind of have fully invested that fund, you will go out to your LPs and try to raise another fund. Ideally a bit bigger if you're successful. And if you have a good track record, you can maybe go from a 2 billion fund to a 5 billion fund. In the case of EQT, when I joined, we were a 7 billion fund. Then 2 years ago, we raised a 10 billion fund, and now we're in the market for a 15 billion fund. And that's kind of how it goes. And so you are continuously raising more and more capital, which you're then deploying with your organization while trying to make a good return. Now, how does this process actually work of buying and selling businesses? It's basically what we call the deal life cycle. And as an investment professional in our teams, you're basically responsible for every single aspect of the deal life cycle. And very simple, I put it here on the top of the page. I mean, you start with the sourcing. Sourcing is just basically the identification phase. You try to analyze industries, you try to analyze certain trends, and you try to identify the most attractive companies behind those trends. The way we do this is by talking to investment banks. I understood you guys had a presentation earlier today from the investment bank. These guys, they continuously supply us with investment ideas. But then we also do our proprietary research where we talk to management teams. We have a very broad network of CEOs and ex-CEOs that we've worked with, and they also continuously feed us with investment ideas. And once we find an opportunity that we like, that we find attractive, and that is actionable, and with actionable, I mean the current shareholders are willing to sell part of their business or are looking for a strategic investor like EQT, then we kind of move to the next phase and we actually start doing due diligence. The due diligence phase is the phase where EQT, together with all its advisors, so commercial advisors like McKinsey, Bain, BCG, our financial advisors and our tax advisors like KPMG, EY, etc., and legal advisors, etc., we actually go into the company and we try to understand every single aspect of it. because you want to make sure that you fully understand what you're buying. Because in the case of EQT, I mentioned our fund is 15 billion. We typically do 10 investments out of that fund. That means that each investment you do, you're going to put at least 1.5 billion euros at work. So when you do such a transaction, you obviously want to make sure that you're not missing anything and that you completely understand how the company works, how its financials works, that on the legal side, there's no massive claims, because the last thing you want is you buy something and the day after you discover something which you did not have accounted for. And it happens. So that's why you do the diligence. And that's also why we surround us with the best experts in the business, which are consultants, which are external parties. If you're successful, the way it typically works these days is that most processes, as we call them, are auctions. So it's typically unlikely that you're the only one trying to acquire a business. I mean, in the ideal case, you are, but most of the time you need to compete against other private equity firms. And the way it works is kind of a two-stage auction typically, where in the first phase you need to submit an initial offer and you need to substantiate that offer. You need to say, I mean, we are willing to bid this. Our offer is based on kind of these assumptions. This is why we like the business. This is how we want to drive value for the business, etc., etc. And you're continuously trying to position yourself as a good party to transact with. Then the sellers, they will typically choose a couple of parties, maybe 2 or 3, and these go to kind of the round 2, which is the advanced due diligence process, at which point you get even more access to information. And then you quite quickly move into the negotiated transaction phase. The negotiated transaction phase, that's mainly around, to be honest, a lot of legal things. So as part of this whole process, you need to negotiate what they call an SPA. That's basically the legal document that's typically 500, 600 pages long, that will basically describe how the transaction is going to happen and also documents how every single aspect of the transaction will work. And you can imagine if you're buying a business, with 4,000, 5,000 employees, global footprint, 80 locations across the world, quite complex, a lot of people involved, a lot of parties involved, a lot of customers involved. You need to make sure that this legal document kind of captures all potential eventualities so that you know how to deal with them. And that's what happens in the transaction phase. And then if you're successful, which is not easy because private equity is highly competitive. So we just lost 2 deals, I would say, in the last 3 months. It's highly frustrating, but it happens because there's so many other private equities going after the same attractive targets. But if you're successful, then you get to the really fun phase, which is the management phase. And that's basically the phase during which you, as a private equity owner, you get hold of the keys. And together with management, you will try to drive value in the portfolio company. And what you're trying to do is very simple. You're trying to make the asset more valuable than its starting point. Because your goal is, and that's written also on the page, our goal is to, in 4 to 5 years, we need to at least double the money that we put in. Ideally, we go to a return of 2.5 or higher. This highly depends on what asset class you invest in, but for my private equity fund, that's kind of what we target, 2 to 2.5 times our money in 4 to 5 years. That means that, from the moment you own the business, you immediately need to start working on a plan to drive value. So we typically work with, for example, a 100 days plan where we, in quite a lot of detail, map out kind of the key milestones you want to achieve in the first 100 days. What are kind of the 3 topics we want to focus on? Do we quickly want to invest in a specific product or service? Do we want to hire a whole bunch of salespeople? Do we want to invest a lot in digital? Do we want to implement a new CRM system, ERP, etc.? But having a plan and starting early is kind of one of the key drivers of success here. And on the bottom of the page, I've tried to summarize a little bit of what are the different ways we can actually drive value for our portfolio companies. I think the 3 things on the right is typically more the operational things, multiple, so top line growth, cost margin, M&A, and then multiple expansion and leverage. Those are more financial factors. And I'll go into leverage in a bit more detail. But if I focus on top line growth, cost margin, and M&A, those are really the things that you need to have a clear view on even before you buy the business. So before we buy a business, as an investment professional, you need to make and you need to build a very detailed business plan, which you need to calculate your returns, and which you then also need to be able to execute on during the management phase. And getting this right is basically the whole point why you do diligence and what you're trying to do during the acquisition phase. And on top line growth, I mean, it speaks for itself. It's just continue to grow the business and ideally try to accelerate that. Cost margin, that can be then, how can we be more effective at pricing? How can we think smarter about our cost base? Can we, for example, put in place a bonus scheme so that people are more incentivized to work harder, which is then going to drive better margins? And the M&A piece is something that has recently happened in the last 5 to 10 years. What you increasingly see is that private equities like us, we buy a business and then we try to acquire smaller businesses to kind of complement to our core business. And that's how we grow the business. We make it bigger and more attractive. Multiple expansion, that's basically where, for example, in the VC world, I'll take a simplified example here, but a company might be at some point sold for 5 times revenue. And then because the owners, I mean, further invest in the business and the management team manages to kind of build an even stronger business, maybe 4 or 5 years later, the business is sold for 7 times revenues, while it was only valued at 5 times leverage. That delta, that's what we call multiple expansion. And then, I mean, after the value creation, then comes the exit. That's kind of the reverse process of the whole buy process. But at this stage, we are in the selling position. And then obviously our job as an investment professional is to find the right buyers that are most eager and have most conviction on our business and are willing to pay the highest price. I will say though here that highest price is not always the key driver for us. I think we are, as EQT, very responsible owners, so we also typically want to try and find a good home for our portfolio companies. If we have the option to sell to kind of a party that has a good fit with management, has a good vision for the future, we will always opt that over picking just an offer that is 10 million or 20 million higher. Because we also believe that if you do this, if you have the long-term vision, that will ultimately pay off. And that also speaks to our reputation. We are one of the most reputable investors in the whole industry. And then maybe quickly on leverage, I'm not sure how familiar everybody is with leverage, but that is basically one of the, I would say, more financial engineering tricks we use to kind of boost our returns. And leverage basically means in Dutch, hefboom. And the way we do that and the way we kind of create leverage is by using debt when we acquire companies. And maybe just very quickly, I've made 2 scenarios here on the bottom of the page. The left scenario is basically a scenario where we don't use debt, so no leverage. We buy a company for 1 billion and we sell it 5 years later for 2 billion. Quite easy. Our return is 2 times. I mean, we got 2 billion out, we put 1 billion in, return is 2 times on our investment. If you then go to the example where we do use leverage, you can see that initially we put in 700 million of debt and 300 million of equity. At the end, our business is worth 2 billion still. And the 700 million of debt has actually increased. Why? Because you need to pay interest. So this debt is held by banks and other debt investors. They require a certain return of that debt. So that debt will grow over time. And then the equity, the remaining equity is 1,250 million. But what you see is by using this leverage here, you've managed now to create 1.2 billion of equity for a 300 million investment. So now suddenly your return on investment is 4.2. And this is why we use leverage, because it helps us to boost our returns. I do have to say though that, I mean, this is obviously how it works in a good case. There's a risk involved with leverage, and if things go sour, then quite quickly you also lose all your money. So I mean, this is what you guys know very well. I mean, this is financial theory. By using leverage, you create a higher risk profile, and then that also justifies the higher return profile we are getting here and the higher returns we're generating. Then quickly on EQT. So EQT, as I said, I mean, we're one of the biggest private equity investors in the world. We were founded roughly 26 years ago in Sweden. So we're kind of a Swedish heritage firm. Since then, we've raised 62 billion in terms of commitments. We've made more than 500 investments, I think by now 200 exits. And kind of, yeah, we try to differentiate ourselves quite a bit from the rest of the market by actually kind of that Swedish heritage and that Swedish culture that we have. And that is basically what we try to describe here on the page. We have a very strong and value-based culture. For us, values is everything, and doing good is extremely important, and especially around sustainability, digital entrepreneurship are kind of our core values, and that really sets us apart from some of our more Anglo-Saxon competitors that maybe just have the old school private equity mindset of we just want to make money, doesn't matter how, don't care about the employees, don't care about the rest. But that's definitely not what we do. The second thing, what differentiates us or how we think is we focus on growth. So there's different type of private equity players out there. You have the guys that acquire failing businesses. They try to restructure them, do a lot of heavy cost cutting, kind of try to get the company back on rails and then sell it with a profit. That is an art in itself, and it requires very specific expertise. Our focus is more, we try to find the market leaders. We try to find the market leaders in the most attractive niches, and then we try to make them even better by accelerating their growth or making further investments in their platform, etc. That's kind of how we operate. And that also speaks, if you look at our returns, that's very highly correlated to kind of driving growth. A couple of other things I would highlight. We are very well known for partnering with families and founders. We've done it multiple times, and we've been highly successful there. Another thing we focus on all the way at the bottom of the page is a lot on digitization. So we've built up a world-class team of internal digital experts that we kind of that kind of help our portfolio companies to kind of drive digital transformation in their businesses. So these guys are ex-Spotify, ex-Google, ex-Amazon, ex-Tesla, kind of a whole bunch of experts, and they actually help to drive value for our portfolio companies. And this is also a big selling point when people sell to us. They know that, especially the management team, they will get support from us to help drive performance in their business. This I'll very quickly go over this page, but this is basically our portfolio in the Benelux. The investments on top, Deze, Cureos, Azelis, Bureau van Dijk, and Dunlop are our private equity fund investments. We also have a couple of venture investments. I understood that you guys had an intro from Lucas Stoops from Force Over Mass. That's basically, we have a similar fund, but with a slightly different focus. And then we also have credit and infrastructure investments. I'm personally responsible or involved in our Deze and Azelis investments. I think Deze is a leader in the mobile industrial filtration. It's a typical, I would say, Belgian KMO, but with huge potential that is now building hard on kind of rolling out globally and internationally. So we're really scaling that up to a European platform, and that's been so far one of our very successful investments. They're based in Roeselare, West Flanders, which is very close to my home, so that's also kind of a nice bonus. So it's very fun always to go back and build that business together with the team. And then Azelis is a global specialty chemical distributor. Huge business, 2.5 billion in sales, very profitable, very strong business model, and a very strong management team. And there we're mainly focusing on just global expansion and especially building out that business in Asia Pacific. And then when it comes to private equity and how do you break into this industry? I mean, maybe a first disclaimer, and this is not a popular opinion, but this is just the way it is. I think I do have to say that getting into PE is not easy. And the reason is that many people that are working in finance, people that are working at McKinsey, Goldman Sachs, JP Morgan, Morgan Stanley, the investment banks, they all for some reason they all see private equity as kind of the promised land, while at the same time kind of the number of positions within the firms is relatively limited, because also my team here, for example, we're one of the biggest teams, but for the Benelux we only have 10 people, so that means yeah, there's few positions available. That being said, I think it's definitely not impossible. I think I'm a strong believer that if you have kind of the drive and the motivation and you kind of set your mind to it, that anything is possible. But I do think if you guys are now already starting to think about private equity, it's probably worthwhile to already start planning a little bit ahead on how you can get there. And there's different private equities out there. Some of them might hire you straight from university. I think it's a little bit unlikely because yeah, these are small teams. They don't really have the capabilities to give you a proper training and help you understand kind of the basics around business models and how to drive business sense, and then also the whole financial modeling side. So that's why, at least in my firm, we only hire from consultancy firms and or investment banking firms, typically analysts or associates with 2 to 3 years of expertise. And yeah, that's at least our preference. We typically like to hire from blue chip names, which some of them I've put on the page here. So if you guys are interested in private equity, I would highly urge you to, one is probably already start thinking about internships. I know that there's a couple of people in Capitant actually that have already done internships at private equity companies. So that way you can build a little bit of credibility, track record, and also understand how it works. After university, if you have the option, going into consulting or investment banking is definitely not a bad move, and it's typically the stepping stone into private equity. Both tracks will learn you very different things. The consultants are typically a little bit better on the business sense and understanding how businesses work and how to deal with organizations and management teams. I think the bankers are typically very good at understanding the deal process and the financial modeling and valuation. Both skills you basically need to become a successful investment professional, but there's kind of two paths towards it. And then, yeah, I mean, what I see as kind of common threads of successful candidates, it's people that plan ahead, people that have a plan in their mind, prepare adequately, are also passionate about the industry, and kind of, yeah, don't shy away from also investing a lot of time up front before going into interviews. And then, of course, I mean, just having kind of the technical and quantitative skills and kind of business sense is also very important. But I believe that most of these last skills, you can either learn them or you will get them over time as you kind of build your expertise. And that's basically it. I mean, if you guys want to learn more about EQT, feel free to look at our website, also on YouTube. I think we have a lot of cool videos on both EQT itself, on our portfolio companies, where you kind of see how we work and what we do. So yeah, would be great if you guys go and have a look there. And of course, feel free to ask questions during the Q&A after this session.